Okay, I would say we're going to start with our webinar for today. To those of you who are based in Austria, good morning, and everyone joining us from Australia, good evening. Welcome and thank you very much for being with us today. My name, for those who don't know me yet, my name is Matthias Mikulai. I'm responsible for the construction, infrastructure and energy sector at the Austrian Trade Commission here in Sydney, and I will be guiding you through the webinar today. Before we get started, let me mention just a few house rules. After I'm done with my introduction, we will dive into carbon reporting, followed by a Q&A session at the end of the webinar. Please feel free to submit your questions at any time via the Q&A function. We can also later on open your microphones if you'd like to turn this into more of a discussion rather than a monologue. So that's also possible. The webinar is being recorded. The recording will be sent to all registered participants within the next 2 or 3 business days. So in terms of you have still some questions, you can rewatch it and then reach out to us as well. Why are we doing this webinar today? For a long time, Australia had little incentive to process raw materials, avoid or recycle waste, or reduce CO2 emissions due to seemingly unlimited natural resources and a low population density. Coal and natural gas remain Australia's main export commodities and are a major source of national prosperity. However, when emissions are considered on a broader consumption-based basis, these exports give Australia one of the highest CO2 footprints worldwide. Climate-related disasters and other environmental challenges are also becoming more frequent within Australia itself, and in addition, the Pacific Island states, which Australia relies on as important geopolitical partners in that region, are under serious threat from rising sea levels. With the Labour government coming into power in 2022, a clear shift towards greater environmental awareness took place. Measures such as the safeguard mechanism were strengthened, requiring Australia's 215 largest emitters of CO2 progressively reduce their emissions. At the same time, Australia still does not have a general CO2 pricing mechanism. Today, Australia's domestic energy generation has a strong share of renewables, in particular South Australia, at times already close or at net zero due to high solar power. Tasmania as well, because they have a lot of pumped hydro. Against this backdrop, Australia has now taken an important step towards consistent and comparable sustainability reporting with the introduction of the AASB S2 standard. That's Australia's climate-related financial disclosure standard. While this standard was introduced for reporting periods beginning in 2025, not all organizations are yet required to report. Many are now preparing for what has changed in 2026 and for what will change in 2027. This webinar provides the ideal starting point for moving from regulatory context into more specific country-focused carbon and climate reporting topics. With that, I'm very pleased to introduce you to our speaker today, Kevin Frohbus. Kevin is a partner in BDO's advisory practice based in Sydney, specializing in corporate and sustainability reporting, IFRS advisory, and climate and carbon accounting. He supports clients across sectors, including infrastructure, technology, retail, manufacturing, wholesale, and financial services, and leads a team offering clients carbon accounting and lease accounting solutions via BDO's proprietary lease management software and outsourced lease management services. With that, Kevin, thank you very much for joining us today, and over to you.
Thank you, Meta. Thank you for having me here today. It's really an honor, and I'm looking forward to getting into this discussion. I have prepared a bit of a slide deck, which I will start presenting now, and I think this has been made available to all or will be at some point in the coming days. So thank you for having me, and I'm really happy to talk through this topic on mandatory climate reporting in Australia. That was a wonderful introduction, by the way. I could not have done it any better. So very good context to what we're talking. Allow me to kind of get into what today's session is about. What are we going to talk today about? So the three things, as already mentioned, is going to be an introduction to what we call mandatory sustainability reporting in Australia, a high-level overview of the work that needs to be done and what the timing looks like, and what can you do to embark on this journey. It is Australian specific, but for those of you who might be in Austria and working with a local subsidiary or local business in Australia, you get a good understanding of what's required in Australia. It will sound very familiar or similar to what's happening in Europe, but there are some differences in the Australian context that you need to be aware of. Primarily that Australia has adopted this already in 2025, and it will be mandatory in a very short period. While I think in Europe, some of it's still taking hold and has a sort of a longer implementation. As has already been said, I'm Kevin Frohbus. I'm a partner at BDO. So I've put your my contact details up there in case anybody wants to contact me. I noticed that I look prettier in my picture than I do on screen in real life. So we'll just move forward from that and get going with the presentation. So let's take a look at the overview of mandatory climate reporting. What I'm going to do is just cover some terminology in the first instance, because I think there's a lot of acronyms and letters to use, and just explain how this relates to the broader global attempt at climate reporting. What's really important is that the Australian reporting has been based off the International Financial Reporting Standards. So the International Financial Reporting Standards, or the IFRS Foundation, which is a global organization and it's based out of Europe or out of London, so it will be familiar to most of you, sets the financial reporting standards. So those are the standards that organizations, mostly listed companies, use to prepare financial reports for their shareholders. They've created two bodies, which is the AASB, which sets accounting standards, and the ISSB, which sets sustainability disclosure standards. And it's out of that standard setting body that we have this mandatory climate reporting standard. I won't go through all of this, but basically in Australia, what we've done is we've taken the international standards from the ISSB and adopted at least the one on climate, which is called AASB S2 in Australia. So that's climate-related disclosure. So in summary, very much linked to the international standards. These standards are based on the IFRS S2 and S1 standards, and we're adopting the climate-related disclosure one in Australia. Now, what's important here is there are two standards coming out of the international body. There's what's called S1, which is your general requirement for sustainability disclosure. And then there's S2, which is the climate statement. In Australia, we have adopted S2 as a mandatory statement. So that one has actually been enshrined in our corporate legislation, which means it has legislative backing. It is required by law. Directors of companies have an obligation to create systems and processes to deal with that standard, and the requirements to actually prepare a mandatory sustainability report is then governed by regulation, and there are actually penalties for companies and directors if they don't comply with that standard. The S1 standard, the general standard, is not mandatory in Australia. It's voluntary, and you would use that standard if you were doing disclosures that were broader than climate. So if you were doing disclosures that maybe included human capital or biodiversity or some other ESG topic, you might use S2 as a voluntary reporting standard. And that standard will help you basically prepare a voluntary sustainability report that is not been adopted in Australia on a mandatory basis. And so the purpose of this discussion today is focused very much on S2, which is your climate standard. Now, what does the climate standard require? Very simply, the standard, it's quite long and onerous, and there's over 200 disclosure requirements in the standard. But ultimately, what it's trying to do is to say to companies, please prepare a report for my investors or for my shareholders that outlines the effect of climate-related risks and opportunities on the business, and explain how resilient the business is to climate and how it monitors and measures performance. That's a lot of words. It's basically saying, tell me how the business is impacted by climate. What are you doing to manage it? And actually, what is the financial impact of those climate-related risks and opportunities on the business? Now, broadly, it breaks the disclosures into 4 buckets, or to 4 sort of disclosure areas. But the most important one to start with is actually the second column, which is strategy. The whole point of the disclosure is to isolate what are the climate-related risks and opportunities that impact the business, and what is the strategy to manage those. So the key disclosures generally start in the second column. What exposure does the entity have to climate? How does it identify those risks? What are those risks and opportunities? And then what do you do? What is the organization or the business doing to manage them? There are requirements in that column to actually work out the financial impact of those risks and opportunities, because at the end of the day, this disclosure standard is actually an investor-focused standard. So what that means is you need to prepare disclosures for the shareholders, the bankers, and the financiers who are providing capital to the business. Those are the target audience of this report. This is not a broad sustainability report like a broad ESG report. It's very specifically targeted to talk to investors and bankers and financiers about how climate impacts a business, and therefore you would expect there to be some sort of financial impact disclosure. Essentially, how does climate impact us, and what are you anticipating that effect to be on the profit and the balance sheet of the business? There are lots of other disclosures that go with this. You do need to disclose in column 1 governance processes and procedures. So how does the organization essentially monitor climate-related risk, and what are how the audit and risk committees and the board processes designed to actually manage those risks? In the third column there, you need to disclose information about risk management processes, and then there's metrics and targets. And the metrics and targets includes disclosures about emissions, such as scope 1 and 2 and 3 carbon emissions. I'm not going to talk much about carbon emissions today, but the idea of carbon emissions is that you should be able to articulate your carbon footprint, and if you're actually doing anything to reduce that or manage the carbon footprint as part of your strategy. So one of the biggest pieces of information that we find is required to be gathered is the data to actually measure your carbon emissions, the emissions that you generate directly or those that are generated in your value chain. Now, this part of the presentation starts to get into how you might actually approach getting ready for this, because as you can see, this is not a small requirement. It's not just a couple of numbers in the financial report. What's actually required in Australia is that you need to include this mandatory sustainability report together with your annual financial report as part of your annual compliance cycle. And most organizations in Australia, most companies in Australia would have to prepare, their annual financial report. This requirement requires the sustainability report to be presented together with that annual report, which means you actually have to prepare it to be ready for lodgement with the regulator within 3 or 4 months of the end of the financial year end. But because you have to also prepare all this information, not only climate risks and carbon and resilience and so forth, you actually need to develop a roadmap and a framework to prepare for this. So most organizations go on a journey where their first steps are actually to understand how ready they are for S2, for the disclosure. And the key step involved in that is to actually do a climate risk and opportunity assessment. You can't really do any of the other disclosures until you have an idea of how exposed the entity is to climate risk, what those risks are, what those risks are driven by, what are the risk drivers, and are there any opportunities that might be explored, such as exploring renewable projects or any other opportunity to actually adopt climate-related initiatives. Once you understand your climate risk and opportunity, which normally involved an assessment with stakeholders in the organization, so you normally work with people in procurement, operations, and the board, as well as perhaps maybe suppliers, to understand how they see climate risk affecting the business. Once you finish that step, you normally end up with a climate risk register, and that climate risk register can then help you move to all the other steps in the process, such as gathering data to report on how climate risk and opportunities are measured and monitored. So you normally need to gather data to essentially articulate performance and start gathering data to report your carbon emissions. There are some other requirements in the report which still need to be addressed. Climate risk and opportunity has to be stress tested under a scenario analysis. You then need to also work out the financial impact of those climate risks and opportunities. The financial impact is to actually work out what is the current and anticipated financial impact on the financial statements. So that is why it's important to present this report, the sustainability report, together with the financial report, because the two reports need to talk to each other. You need to be able to articulate to the investors how your financial report will change over time based on the impact of climate. And then you need to assess resilience, which is basically testing how the organization or the company is planning to address and react to changes in climate warming potential. So as we have a 1 degree or a 2 degree increase in global warming, how is the business going to actually react to that, and how resilient is it to that change, before you ultimately include all that information in the draft report, which will then be, become your mandatory sustainability report. Lots of information there, I do understand, but you can see from that there's actually quite a bit of work to do, because some organizations will be doing this to varying degrees. Some organizations that we work with in Australia haven't done anything on this. Other organizations, especially if they're part of European subsidiaries, maybe their global parent is working on this already, but they wouldn't have done it in Australia. So the Australian entity has to go through all these steps in the Australian context before actually getting to the report. What's important there is also to note that this is an Australian standard, and therefore it relates to how does climate impact the Australian reporting entity or the Australian company. It's not sufficient to just get information from the parent entity in Europe or America, wherever you might be, and just include it in the Australian report. You actually have to tailor that information for Australia and actually articulate it in the Australian context, which I think is what some organizations are struggling with. I did sneak this slide in, so I will say that the slide actually is not in the slide deck that was sent to you, but I thought it would be useful for context to actually show what the ultimate aim of the standard is. And the ultimate aim of the standard, if you have a look, is to essentially articulate your climate risks and your climate opportunities, which is very clearly in the center of the slide, how those climate risks and opportunities have been embedded into strategic planning and risk management and strategic decision making, and what is the financial effect of those risks and opportunities. And those financial effects then need to speak to the income statement, cash flow statement, and balance sheet, which is your financial statements, and the two reports then would interact with each other. The sustainability report is essentially dealing with climate risk and opportunity, and the financial statements are dealing with financial information about performance and cash flow. And then you would want those two reports to be able to talk to each other about how does the financial information change over time as climate risks and opportunities change over time and the company reacts to them. So that's a lot in the first section. Some of that might be familiar to you because it is based on the global standard, IFRS S2. But let's talk specifically in the Australian context about who will need to report and when. So as mentioned by Matthias, this is already applicable in Australia. Now, this is not an easy slide to understand, but it is very similar to the way all countries and economic zones talk about implementing a standard. It's mostly driven by size. The idea is that the bigger the company or the bigger the organization, the earlier it should report. And that's really what's drive what we call the size thresholds. So I'll take, for example, the first row in this table. If you're a large company or an organization in Australia, and we're talking about your consolidated Australian numbers, if you meet 2 out of 3 of the criteria, the size criteria, then you are captured in group 1, 2, or 3, depending on which of those size criteria you meet. So, for example, in the first row, if you're a company or a consolidated Australian company with $500 million or more of consolidated revenue, gross assets of $1 billion, and full-time equivalent employees of 500 or more. If you meet 2 out of those 3 criteria, you're captured by group 1, and your first reporting period starts on or after 1 January 2025, which is what we're already in. So those are group 1 entities, and basically all December year ends group 1s are currently reporting for their 2025 year, and they are about to release their first tranche of reports in the next 2 to 3 months to satisfy that requirement. And you can see then how the criteria apply. If you do not meet 2 out of 3 of any of these criteria, then you're not captured by this in Australia. So there are some entities that won't fall into any of the groups because they're quite small or they fall below the group 3 threshold. Those entities are then not captured by this regulation, and they do not have to mandatorily report. There are 2 other ways you can be captured by this. In Australia, we have what's called NGER reporting, National Greenhouse Energy Reporting. That's a mechanism to report Scope 1 and Scope 2 carbon emissions to the Clean Energy Regulator in Australia. So most organizations who are reporting currently under NGER will know they're reporting because they will already be doing this. And so if you are captured by an NGER reporting threshold, you also get captured by either group 1 or 2 immediately. So NGER reporters or local carbon emissions reporters are captured irrespective of their size criteria. And the reason for that is because they are generally your large emitters. So most resourcing and mining companies are already captured under NGER, and energy and electricity utilities. So they automatically get grouped into group 1 or 2, depending on what sort of threshold they have with the energy regulator. It doesn't matter how big their revenue assets or employees are in that scenario. And then the third way to be captured by this is if you're a financial services company and you have assets under management. So if you have more than $5 billion worth of assets under management, you automatically get captured in group 2, irrespective of your other size criteria. Those are the 3 ways to be captured. I'll leave it at that. BDO does actually have quite a bit of information available on our website, which interprets some of these size criteria. So if you want to look for further information on that, we actually do have a lot of content on there that can help you, because obviously there's a lot more complexity behind it, but that's the sort of base case behind it. What's important is that once you actually prepare your sustainability report, it is subject to assurance by the auditor, and over time the auditor who audits your sustainability report will start to give assurance over different components of the report. I'm not going to get into this slide in too much detail because it's quite technical, and you really don't need to actually understand that in the starting circumstances. The main point to take away is that your report, your sustainability report, will be subject to assurance by an assurance provider, by an auditor, and that report will essentially look very, very similar to an audit report over your financial statements over time, which means there's an expectation that you do need to develop accurate, complete information. You can't just make disclosure statements. You actually do need to gather the evidence to support your disclosures in your financial report and subject it to a level of assurance by your auditor over time. So where should you start? And this I'm going to go through quickly. The important thing is to have a structured project to start this journey. Most companies that are currently reporting, so those are our December 2025 financial entities, group ones, they would probably have been focusing on this for at least 6 to 8 months to prepare for this. But in some cases, they've actually been doing it for years, and the project to prepare for this really does need quite a bit of investment. It's not something that happens overnight. It's also not something that happens, that you can do suddenly at the end of the year. You do need to build a proper project plan to actually embed this into your finance and operating functions. I think traditionally some organizations that have never done this before, either their global parent does their sustainability, or they've got a separate sustainability team that does sustainability. Let's say they do sustainability in terms of sustainability initiatives or ESG factors, but this needs to actually ultimately end up with a report that needs to be audited, and it actually is finance in nature or investor in nature. So therefore, what we are finding over time is that more and more these processes to prepare this report are getting embedded in finance and operating teams. And a lot of those people have never really worked with sustainability or climate before. So there's a very steep learning curve to actually learn the concepts and learn the language, and also understand how to actually work with climate risk and opportunity and work with scenario analysis in order to generate reports. So we generally have five aspects you want to focus on. You want to make sure that before you start anything, that there's proper awareness in the organization, and that you actually start to deal with stakeholders. So for example, if you're an Austrian company that has a parent in Austria, you want to make sure you've dealt with your parent to understand the stakeholder needs. You then want to start to make sure you understand the governance and risk integration of climate in the Australian context, because this is the report for Australia. You want to make sure your processes are designed and fit for purpose in the Australian context to gather this information. Some information might come from a parent entity overseas or a broader sustainability team, but this is an Australian specific standard. So you need to have data and processes that are designed to capture the information as it relates to the Australian entity. And then you want to make sure you allow enough information for disclosure and audit, so that the auditor has enough time to assure the report, but you also have enough time to pull everything together and actually draft those disclosures. And then obviously this is not going away, it's going to build over time. So you want to make sure that there's a continuous process to actually improve that. When we work with clients, we often start with essentially a roadmap to try and identify where they are mature, where they are still developing, or where they haven't started. Some companies actually just do a gap analysis where they literally go through all the disclosure requirements and they see whether they have the information. But we take a slightly different view at BDO, where we actually plot the key activities that you need to do in order to reach disclosure, and we break those activities down into four stages. So the first stage is always, have you done your training and awareness? Do you know what entities and activities are included in the Australian boundary? What information do you already have? And if you're doing emissions calculation or gathering emissions data, does that actually comply with the requirements of the standard? Then we move into what we call the build phase, which is stage 2. The build stage is actually doing all the assessments necessary for disclosure. So it starts with a formal climate risk and opportunity assessment that's actually done through workshops, and at the end you end with a register. You then need to do your climate scenario analysis to actually to stress test that, and as well as evaluate resilience of the business. You then need to start building data to measure the financial impact of climate risks. You then need to move into financial scenario assessment if that's relevant to you. And then you start integrating all of those assessments into your strategy, into your decision making, and into your governance, so that you can actually then start to strategically link the strategy and decision making with the financial information and report that in your report. The other thing you need to do then is emissions calculations. You do need to disclose your carbon footprint, and so obviously doing formal information around emissions methodology and boundaries is important. So that's stage 2 are all the activities you need to do in order to produce the information for disclosure. And you can see already there's a lot to do there. Stage 3 talks about transition planning and target setting and carbon pricing. None of those things are mandatory in the report. You don't need to have a carbon transition plan, or you don't need to have carbon or climate targets. But if you have them, you do need to disclose information about them. So that's what we put into stage 3. And then stage 4 is actually gathering all this information up, preparing your report, putting it together for the auditor, and making sure the auditor can then have a look at it. So we generally design a roadmap for a client that starts with understanding the maturity in those areas. And then that normally translates to a time horizon of plotting when are we going to do all this, because some of this needs to be done in order. You can't do a scenario analysis without doing a climate risk assessment. So you do need to sequence the events. And we normally put them into time horizons, time horizon 1, 2, and 3. And that is normally then plotted over a timeline, taking into account basically when all the activities will be prepared, what information is going to be needed, when will the assessments be done, who will be involved, and then what information will be generated. Now, this is just a case study I have on screen, so it's just a very, very high-level example of what that might look like. You can see in this scenario, this is of an entity that might start in the first quarter of 2026, which is where we are now, and they would not be able to prepare their first report until the end of 2028. So this is an entity whose first reporting is in 2028. So they would be a group 3 entity further down the chain. They're not required to do it in the current year, but you can see that they would spread all these activities out over a 3-year period. This is a fairly comfortable roadmap. You would be able to do quite a bit over a period of time, and you wouldn't need to hire too many people to help, because what you would do is you would do some of these activities over a 3-year period. So basically, you wouldn't need to get your staff and employees to work on this constantly. They would be able to do this at a sort of a leisurely pace, but that's not always the case. If you haven't started and your first reporting period is at the end of 2026, you can just see how much information has to be gathered in a short period of time, and that's when it becomes quite a risk of achieving the roadmap on time. Right, I'm going to stop there because that's all I wanted to talk about, and it's very quiet. So at this point, it wouldn't be the worst thing to hear from the people online. Any questions? I'd ask Matthias to come back and see if there's any questions from the group.
Okay. Thanks, Kevin. That was very informative. And we actually have a few questions. So one question that was a very basic question actually is, which currency is used in your slides? Is it Australian dollar or US dollar?
It is Australian dollar, and I'm glad you asked that question, because when I was talking about it, I wondered if I should make that clear. So it is Australian dollars, because it obviously it's Australian standard, and you know, all the numbers are so converted. I'm actually just going to go back to that slide. I just want to point something else on the currency. Those numbers, let's just bring this up again, I think. So this is the slide we're talking about. Those numbers are Australian currency. And you would compare those to the numbers in the Australian financial report. So the 500 let's take group one. The 500 million would be compared to the revenue number in the consolidated Australian financials. The gross assets would be compared to the total assets in the Australian relevant entity, and the employee numbers would be all the employees that are called full-time equivalents in the Australian reporting entity. Some entities don't report in Australian dollars because they might have a different functional currency. So even though they're an Australian entity, they may prepare financials in, let's say, US dollars. Then you would need to do a translation to evaluate this hurdle, because these numbers themselves are Australian currency.
Okay, thank you very much. Another question. What do companies typically underestimate when they start preparing for that climate reporting?
Very well. I think the main thing is the time it takes to prepare all this information. So that's an easy one. I think they underestimate the skill and capability needed in the organization to do it, and they underestimate the time that their employees have to devote to this. Some organizations will try and give their existing employees the ownership of this project on top of their day-to-day job already. So what ends up happening is it becomes this project that no one has time for, but everyone has to be involved in it, and there's a lot to do. So it's really about time and capability. You really want to get that right. In the global context, which often involves parent or European countries and, let's say, Australian countries, one of the things that is underestimated is a lot of this information does not exist at the global parent. So the global parent will prepare sustainability information for, let's say, a global organization or a European company, and that they might not prepare Australian specific information as part of that, and that's something else that's underestimated. A lot of organizations who have a European or a global parent will say, oh, all this information is available at the parent. But when you ask the parent company only has European specific information or information for other sort of jurisdictions and countries. They don't actually have, specific Australian information. So for example, climate scenario analysis, which is one of the activities, you need to adapt your climate scenarios to Australian risks and transition risks if you're operating in Australia, because that's the entity that you're preparing disclosures with. And often the scenario that's been done at the global entity hasn't considered the Australian context. They would have, so then the information is really, really not available. So that's more than one. There's about 5 or 6 things there that are underestimated. But the key one is to get started early and be prepared and devote the right amount of time to this, because it takes a lot longer than you think it does to gather this information.
Okay, thank you very much. Another question is more about which entities do have to report, because in your slide it says, let's say, Group 2, 200 million financial year consolidated revenue. Just for clarification, does that mean not only the subsidiary in Australia, it's the mother company included, the revenue?
Very good question. That is actually a really good question. So maybe I should have put a diagram. It's the Australian, so it's any individual Australian entity. Mm-hmm. Then sometimes what you get is you get an Australian head entity. So it'll then be the Australian head entity and all its subsidiaries. So it doesn't include a parent entity in another country. It only includes reporting entities in Australia and their subsidiaries below them. Now, sometimes you have a situation where the Australian entity has a subsidiary in America. Well, yes, it'll include that because the Australian entity is the parent, but it won't include an Australian entity whose parent is in another country, if that makes sense, because that entity is covered by the country that the parent is covered. I hope that was clear. If that wasn't clear, tell me and I'll explain it again.
I think that was very clear. Thank you. Another question would be, for, let's say, 2028, will there be, or do you know if there are discussions that even smaller companies will be affected by this reporting? Like compared to Group 3?
Currently, there is no discussions that I'm aware of to expand this beyond the entities on the screen. And this also only covers companies. It doesn't cover charities, for example, and it doesn't cover not-for-profits. So currently, most charities and most not-for-profits are excluded. Most, not all, but most. So this really only includes for-profit private and public companies. And I don't know, I haven't heard that they want to expand this. It's just the entities on the screen right now.
Okay, thank you very much.
Anybody that's not in Group 3, 2, or 1 would be excluded for now.
Yeah, okay. One question that is, I think, very important is, where do you see organizations struggling the most of? You already mentioned they should prepare as early as possible, but
Yeah.
other than that, is it with governance, the data quality? What's your experience?
That's a good question. Most companies we've worked with, once they get organized, they are able to bring most of the information and the data together pretty quickly. They actually, it's not a function of the info isn't available. It's a function of getting organized, and then they can actually, find what they're looking for. But it is difficult, I'm finding, to understand how to apply scenario analysis to business resilience. That's quite advanced for some companies. Most companies don't do formal resilience testing, so it's quite a big jump to suddenly have to do resilience testing on warming pathways when they don't have formal business resilience processes to begin with. So that's one area. But then the other area we really struggle with is you have to work out financial impacts of the risks. You actually have to quantify the current and anticipated financial impact. And that becomes an issue because you're really doing almost advanced financial modeling at that point. It doesn't have to be a complex model, but you are heading towards, forecasting more than just budgeting. You're forecasting financial impacts using a variety of data sources. So that also becomes complex. There is definitely a data quality problem generally, but it's probably not where you think it is. I think most entities think that the biggest problem they're going to have is their carbon emissions data. That's scope 1 and 2. So scope 1 and 2, I haven't really run into a problem with scope 1 and 2 for most organizations. It turns out that they do have the data once they go looking. It's just a matter of going to look for it. But I definitely think that scope 3 carbon emissions is quite problematic because scope 3 carbon emissions requires data from your suppliers and customers. So you need to actually get data from other parties. That is a problem. And then in the financial modeling, again, you do need data points to do the future-looking modeling. And a lot of organizations, they don't keep track of non-financial data. It's really hard to find non-financial data. So yes, there is a problem there. But I think that data quality is something that will happen more in year 2 of the reporting. You don't necessarily need... You won't need to do all the disclosures in all circumstances in the first year. I think there's a acceptance that you will get better over time. So although data is a quality issue, there's no doubt about it. I think coming back to resilience assessment and actual building financial models, those areas can get quite tricky, especially if you don't have skills in the organization to do that.
You mentioned it's difficult sometimes to get the information from your suppliers. So eventually, smaller companies are affected by that because they need to know then what's in their product, how many emissions do they produce by manufacturing those products.
That's correct. And that is a very good point, because although I said Group 3 isn't if you're not group 1, 2, or 3, you aren't captured by this reporting. That's true, but that doesn't mean you're not affected by this reporting. That is absolutely true. And so if you're a smaller company, you will be asked for some data from your suppliers, but that's not a requirement under the standard. That's something more of a business relationship, and that is true. I'm not aware of any company that has been asked to produce a full mandatory sustainability report covering all these dimensions just because their supplier or their customer wants it. It's the investors that need this report. But you're correct. If you are important to a supplier or a customer in your value chain, they may seek information from you, and then you need to deal with that through your normal, supplier and customer relationships. And we do have some small companies in Group 3 who are being asked by their Group 1 customers and suppliers to produce specific pieces of data for them. And yeah, you need to get ahead of that.
Okay, that's interesting. Good to know. Yeah. I think there are no other questions of the participants. If you have a question, please raise your hand and maybe we can add you to the discussion. If that's it with the questions, before we'll finish this webinar, I would like to say a big thank you to Kevin and your colleagues at BDO who made this webinar possible. Thank you very much for giving those insights. To round up the webinar, I just want to give a brief outlook of what we are doing in the next months for our Austrian companies and subsidiaries. So we are planning currently a few delegations. So the first delegation that's happening this year is in mid-May. It's around health. We will go to Melbourne to visit the Digital Health conference, and this delegation is specifically interesting to everyone, or could be interesting to everyone that not only deals in digital health, but also in health in general for enlarging your network in Australia. The second delegation we are organizing is in mid-June or beginning of June. We will travel to New Zealand and visit Field Days. That's the biggest agriculture exhibition or show in the Southern Hemisphere. So this is all centered around agriculture. New Zealand has a big exporting market, especially in dairy and other products. In the end of August, beginning of September, we're going to visit Fiji and PNG. PNG has a big mining sector. Fiji is looking into renewables. That delegation is not targeted into any specific sector, so it's sector-wide, and we can target or arrange meetings based on the interests of the company. In mid-October, based on our success of last year in October, we organize another delegation into the mining sector. So again, we're going to visit Western Australia, a few mines there, organize site visits, and then later on travel to Sydney again to visit IMARC. That's one of the biggest mining conferences and exhibitions in Australia or in Southeast Asia Pacific. And at the end of the year, at the end of November, we're going to organize an infrastructure delegation. We're going to travel to New South Wales and Queensland. Those two states have the biggest infrastructure budgets. We're going to look into roads, rail tunneling, but also into the social infrastructure that's connected to the Olympics in Brisbane in 2032. So that is a very interesting delegation as well. And yeah, that's the main events we're going to organize in this year. Thank you very much for joining. Again, thank you, Kevin, for presenting. And I hope you enjoyed the webinar. And yeah, have a great day, have a great evening, and see you next time.